Happy Friday and welcome back to Mortgage Markets and More. I'm your host, Peter D'Angelo from Rate. Thank you for joining today. We have an excellent episode. We're going to talk about interest rates, what's been going on there. We're going to review the National Association of Realtors existing home sales data for February of 2025. And then we're going to discuss how to pick the right lender. And then we're going to tag it out with a fun fact. Let's dive right in. Welcome back to Mortgage Markets and More. I'm your host, Peter D'Angelo. I hope you're all having an amazing week. Here in the Northeast, we're getting a little taste of spring in pockets. So hopefully there's more to come. There's quite a bit we're going to cover today. So we're going to go right into it. We're going to take a look at mortgage rates. They have been a little bit more volatile as of late. So starting off, as per Mortgage News Daily's survey, as of recording this podcast the Thursday morning before its release, our average mortgage rates are looking like this. Our 30-year fixed rate mortgage is averaging 6.8%. The 15-year fixed rate mortgage is averaging 6.22%. The 30-year jumbo is averaging 6.95%. The 30-year FHA mortgage is averaging 6.24%. The 7/6 SOFR adjustable rate mortgage, that's averaging 6.41%. And that 5/1 SOFR arm, as according to bankrate.com, that's coming in at 6.08%. That went up a little bit. Remember, we talked a couple weeks ago how ARMs were back. It was providing some savings. That's kind of gone away a little bit, and here's why. Let's take a look at the bond market. 10-year U.S. Treasury yield is at 4.393%. The 5-year Treasury yield is at 4.133%. And the 2-year Treasury yield is at 4.035%. Across the board in the bond market, we saw all those yields go up over the past week since last episode. Some of them on the shorter end of the treasuries, we're talking about the 2-year and the 5-year bonds, those went up meaningfully. And now they're all sitting above 4%, where we were at least under 4% last week when we talked about that. The 10-year went up as well proportionally, but not quite as much as the 2 and the 5-year. When the 2 and the 5-year go up like that and the 10-year doesn't move as much, that's when you see those adjustable rate mortgages get what we call repriced, and they actually experience a little bit of an increase. The overall survey of mortgage rates is up slightly from last week, with the exception of the 7/6 SOFR arm. That went down just a touch, and I mean 0.01%. The 15-year fix also stayed relatively the same. So right now, again, the opportunity is still here. Yes, there's more volatility, but to echo the sentiments from last week, now is still a great time, and this is a great time to get prepared for the spring market and be as effective as possible. Why did the interest rates move the way that they did? It's a great question. Now let's kind of dive into it. There's not a lot that really occurred. It's been a lot of headlines. So a lot of times I'll report out to you on data, the numbers of what's going on. This is more so sentiment that has been driving the market over the past week. So first and foremost, we've talked about it in the past, but tariffs, this conversation about tariffs and the implication for our economy and possibly price pressures for the American consumer, these are leading to a little bit more chaos in the market. So we are seeing some improvements in the stock market. And when the stock market does well, relatively speaking, historically, we see interest rates go up because people aren't investing in bonds as much. Again, if people aren't investing in bonds, those yields go up. And when those yields go up, interest rates go up. Secondly, we have the Federal Reserve outlook that's getting digested. Last week, we talked about the Federal Reserve and their update on monetary policy, which it stayed unchanged. They did not move their benchmark interest rate. But now the market has time to digest and analyze all of the comments that Fed Chair Jerome Powell made, and then that makes movement happen in the economy. All of this gets us to a point where there was a a mixed perspective that was given to us from the Fed. So now the Fed is looking at possibly 2 rate cuts this year, with a couple Fed governors expecting maybe 3. But all of this is going to be very dependent on how inflation and how the job market looks. So until we get some more meaningful movement, it's status quo, still volatile. And the volatility is getting compounded because now there's also, this isn't new news, but there's more effectual changes happening in foreign policy, global geopolitical tensions and risks. And when those occur, those affect mortgage rates. A lot of different things affect mortgage rates because they are dependent on the market and in this case right now, dependent upon the Fed and what the Fed's saying and what their perspective is on the economy. So this volatility should be expected to continue for the foreseeable future, and that could be a year or more. Best approach is to act prudently and review your own qualifications. If you are a real estate professional, now is the time to really start reinvigorating those clients, to get them up, to start revisiting their pre-approvals, revisiting their price point, their budgets. Some time may have passed since the last time. Now is an excellent opportunity because even though there's volatility, we are relatively flat on mortgage rates after seeing 7 to 8 weeks of decreases for our interest rates. Now we're going to go into the National Association of Realtors existing home sales data for February. It's a very interesting picture that's getting painted for us as we look at how home sales have been going. So overall, we're going to look nationally and then we're going to zoom in. I'm here in northern New Jersey. That's my bread and butter. That's what I'm going to be most focused on. But let's take a look at the national level. Sales volume had a 4.2% increase from January to 4.26 million units sold. That's seasonally adjusted. So a lot of these numbers I'm sharing, again, they are seasonally adjusted. It takes into account the prior history of volume and activity when we get these numbers. The year-over-year comparison is down 1.2% nationally. From February of 2024, that number then was 4.31 million units sold seasonally adjusted. Now let's look at the breakdown by region. So here in the Northeast, sales fell 2%. That was month over month. But year over year, sales rose 4.2% to almost 500,000 seasonally adjusted. In the Midwest, it was flat month over month and up 1% year over year. That accounted for 1 million units of existing homes sold. In the South, they had the strongest volume. They were up 4.4% month over month, but down 4% year over year to 1.91 million units. In the West, we saw a large monthly gain that saw 13.3% improvement, and that's flat year over year. Let's contextualize this data a little bit. In the West, we have California. There were wildfires. There was a lot that was going on there. So when we're looking month over month, maybe the sales volume is ramping up a little bit for the things that were occurring over the past few months in that market. Now let's look at home prices. What is it costing us right now? So the national median price, that's looking at $398,400. Again, the median is not the average. It's the most commonly occurring number, which communicates the best example of what a typical home is going to cost. That reflects a 3.8% year-over-year price appreciation. That's 20 straight months now of year-over-year price appreciation, looking at the median home sales price. That is insane. Let's look at the Northeast in comparison now. $464,300 is the median home sales price in the Northeast region of the United States. That's a significant 10.4% price appreciation from a year ago. 10.4%. That means if you purchased in February of 2024, you can reasonably assume that your home value is somewhere in the neighborhood of 10% higher than when you purchased. This trend is continuing as long as inventory is tight. The equity implications here mean that even though you may have had a 6.5 or Rather, if you purchased in February of 2024, you're probably sitting with an interest rate below 6.5. Rates did dip down in January of 2024. If you locked in and closed in February, you could be looking at something closer to 6%. What that translates to you right now for is quite a bit of home equity, and something to consider if you are in a position or you find yourself with a need to either consolidate debt or possibly do some updates to your property that you've lived in it for a year. Well, you're sitting on some home equity that you could possibly tap into. You could check out on my YouTube channel. I have a couple videos that talk about ways that you can keep your interest rate, which if you have 6.5 or lower, obviously from what we reported out is lower than where we're at right now for our 30-year fixed rate mortgage. So you may want to leverage a second loan program. I have a couple videos on my YouTube page. You can search for me, Peter D'Angelo, Mortgage Markets, and more. For more of that, there's a playlist there that is called Did You Know? And the Did You Know segments are all consolidated there for you to check out. There's one on home equity mortgages, there's one on home equity lines of credit, and then a comparison of the two so you can make an informed decision. Now let's talk about inventory and supply. So when we discuss this, we're discussing what is the current status of what is available to purchase. And right now, the total inventory is sitting at 1.24 million units available. That's up 5.1% month over month, and that's up 17% year over year. This is excellent news, by the way, because this is showing improvement in inventory, something that is much needed, particularly in the Northeast, but I think the whole country could benefit from this right now. The month's supply, this takes into account that figure, the 1.24 million units that are available, and we compare that to how does the industry churn for transactions and how long does it take for that inventory to be exhausted by home buyers. And that right now is holding steady at 3.5 months of supply. So that means that 1.24 million, the way that the market normally operates, usually will last 3.5 months in that neighborhood. That's up from 3 months in February of 2024. So looking at this with the rose-colored glasses in a way, we're seeing improvement year over year. The inventory, though, still remains tight. So when we look at historical standards for inventory, 3.5 months is very short. Normal, healthy markets like to see somewhere in the neighborhood of 6 months. That is anywhere between actually like 4.5 months to 6 months indicates a more healthy market. Once you go above supply levels of 6 months, now we're getting into buyer market territory where it's more advantageous to be a buyer in the real estate market than a seller. But right now, still a seller's market. We can just say it that simply. Let's look at the buyer trends. So let's explore who has been out there purchasing. So let's look at those first-time home buyers. They've been working so hard. It takes a lot of fortitude and determination in this market. So congratulations to you if you are part of this statistic. First-time home buyers increased to 31% of the total transactions for February. That's up from 28% in January and also up from 26% in February of 2024. So that's good improvement. That means first-time home buyers are getting to be more successful in this market. One of the issues, though, cash sales. I'm just going to look at first-time home buyers and cash sales. Those are the two that really move the needle in a big way. Now you're going to know why the first-time home buyers are a little bit more successful. Our cash sales for the month of February was 32% of the transactions. That's up month over month, but that's slightly down year over year. So even though it's up marginally compared to the recent history, that's showing that the people with cash are maybe coming back a little bit when we're looking at the year over year context. The spring market will be very important for us to understand if this is maybe a trend. And the less cash buyers there are out there, the more successful or the higher likelihood of success for the first-time home buyers and the move up or move down buyers and downsize buyers. Market outlook. Let's see how things are looking. And this is a synthesis of all of the feedback from National Association of Realtor, economists, and analysts. There is signs of recovery as mortgage rates are stabilizing a little bit. We got to think of it this way. Having 8 weeks of there not being some kind of crazy, tumultuous movement in mortgage rates, that's beneficial. I said it last year. I've said it for a while now. We don't necessarily need mortgage rates to go down significantly. I think that mortgage rates just need to stabilize so that people know the score. They can budget accordingly and manage accordingly. There won't be as much fallout on transactions. There won't be as many people doing this unfortunate tango of getting in the market and then rates go up and they have to get out of the market because now they're getting priced out. So if we can just have some stability, that will be hugely beneficial. That's one of the bright spots here. Other things to consider, the outlook still sees affordability as a constraint. So as long as mortgage rates are at the level that they are, if they're stable, we can know what we're managing, but it does not change the fact that home prices are continuing to appreciate at an incredible rate. Lastly, we have some regional dynamics to consider. We saw that looking at the South and the West, there was a lot more volume, and the Midwest saw some decline, and the Northeast still has these inventory struggles. So as long as that's the case, we're going to kind of have this status quo of a little bit of a, I'm just going to call it a challenging real estate market. I think that's the best way to put it. Deep diving into the Northeast now, the Northeast was the weakest nationally. Only 22,000 units sold in February, and that's a 48.8% drop. This is not a seasonally adjusted number. So looking at that, that's showing that the affordability constraints are now translating to lower volume. And also without there being enough inventory to satisfy supply. And I'm going to go as far as to say not enough quality inventory. These struggles will persist. And in the existing home sales, despite the month-over-month decline, the region saw a solid year-over-year increase. So there are some bright spots here to this reporting. I'm excited to see what March looks like. We're at the end of the month. I have seen quite a bit more volume and quite a bit more activity. Over the past month and a half, I've seen a lot more pre-approval activity. That normally translates into more activity for buyers in the market. So I'm very excited. So stay tuned for that at the end of April. I will be reporting out more on the National Association of Realtors when that next report gets furnished. Now we are going to move on to our Did You Know segment. So our Did You Know segment today is going to be a little different. We're going to discuss how to pick the right lender. I like to devote my time to educate. That's something that means a lot to me. That's also the approach that I've taken in my business. That's the approach that I take with the families that I help. But I want to empower you with the right information, questions, and things to look for so that you can find the right lender. I am not going to dance around it. I would love to help you, and I would sincerely appreciate that opportunity. However, if you're not in my market, or if you are just looking to find the right advisor for you, I want to empower you with some really great insights so that you can be best prepared when you are looking for someone who's going to wind up and who should be helping you accordingly throughout every step of the process in purchasing your home in very good collaboration with your real estate agent and realtor partner. And for my real estate professionals out there, these are some great things to also take into consideration when you're entertaining relationships with lenders to refer to for the clients that may come to you. So first and foremost, as I mentioned, your mortgage advisor is going to be your greatest ally. They're going to set your price. They're going to help you understand budget. They may help you with some insight in market, but that's really the realtor's forte, and that's their expertise. But they should be preparing you with knowledge, understanding, and it should be transparent in the process. So my first point, item number one, look beyond the interest rate. There is the old conventional wisdom of good, fast, cheap. It's the perfect business triangle. If something is good and fast, it won't be cheap. If something is fast and cheap, it won't be good. And you can kind of see how that goes. This also translates to mortgage interest rates. There are online lenders that offer extremely low interest rates, and that may work for some people, but you may not be getting the service. So you get what you pay for. And albeit we're talking about mortgage rates, and this is a commitment of 30 years, 15 years, 20 years, whatever it may be. But if you don't have the right support and the right partner and the right service, you may not close on that purchase and you may not close on that transaction. You may suffer injury to your credit from a credit inquiry for something that doesn't come to fruition. So that's why the interest rate is not the end all be all. And that's an important point. Underneath that, there's also closing costs. You should understand what the loan terms are. You should understand what that lender's costs are. You should understand if there's prepayment penalties. For my listeners in New Jersey, prepayment penalties are illegal for what's called covered transactions. If you are purchasing a primary residence, second home, or investment property and taking on ownership of the property in your own name, 1 unit to 4 units, prepayment penalties are illegal. So you don't have to worry about that. But in other states, if you're entertaining moving, prepayment penalties could be part of the terms. It's beyond the interest rate. These are things to check for. Whether there's a slightly higher interest rate, fewer fees may actually save you more money. So be considerate of how much a lender could be charging you. And then lastly, beyond the interest rate, make sure that the loan structure aligns with your goals. Secondly, I want to empower you with the smartest questions to ask your lender. So we're going to start off here. Number 1, which programs are the best fit for me and why? You're going to want to ask this question after you've completed an application. I could tell you from my process of assisting families, without understanding what their financial situation is, looking at the credit report, looking at, their savings, what obligations they have, it's difficult to say because there's so many different programs. And with the right lender, their response should be, well, we have a lot of different programs, so it's best for me to understand your financial situation first with your application, and then we can proceed from there. Secondly, can you walk me through all the expected fees and closing costs? This should be a transparent conversation. This is a very direct answer that should be given to you after this question. Third, how do you get compensated? That's an important one. Will you be paying as a home buyer, or are they working off of a commission with the lender that they work and represent? How often will we be communicating throughout the loan process? Now, for me, I like to incorporate this as part of my conversation initially so I can understand what works best for my families and the clients that I'm serving. So sometimes I just will ask, how communicative would you like me to be? But if they don't ask that question, this is a great question to ask so that then you can have a proper expectation of the service that you're getting. This is the big one. That's why I'm leaving this question for last in this part. If rates change in the loan process, how will that affect my loan? Some lenders, I for one, we offer a float down. That means if you start your mortgage process with me, I lock in your interest rate. And then if interest rates improve, we are able to float your interest rate down to where the market is. There could be a cost involved to that, or there could not be a cost to that. It will depend on a case-by-case basis. This is not something that every lender is able to offer, so it's good to ask that question. That will also imply that you will have to negotiate the right time to lock in your interest rate. In my process, it's easy. I have a float down that I offer for my families and clients that I serve, so I don't see a risk in locking the interest rate. But as we've been talking about, interest rates are volatile. So making sure you make good judgment on that is an important factor. Third main point here, prioritize education, clarity, and transparency. Now, in 2008, we had the great financial crisis. There was a lot of laws that were enacted to create more transparency in our business, in the mortgage industry. That being said, though, unfortunately, that does not mean that it translates to 100% transparency across the board. So you're going to want to make sure that you prioritize education, clarity, and transparency. You're going to want to get an education on loan types. You're going to want to understand how credit, income, assets, all of these things affect you and affect the terms of your mortgage. Also, what to expect in underwriting. So underwriting is the part of the process where your loan is actually approved. And there's a person who's involved that will review your loan documents, your loan file, the property at hand, and then issue a loan approval and commitment. You're going to want to understand more about that process and what's involved in it. Fourth, I'm going to say transparency again, but I'm going to pair it with accountability. So you're going to want to have transparency and accountability. A great advisor is normally very upfront and responsive. They'll explain the trade-offs clearly without putting pressure on you to make a decision. They will own up to delays and changes, which can happen in the process. Unfortunately, but also fortunately, the process has many people involved, so that provides some protection and some iterations of continuity. But when you have a lot of cooks in the kitchen, you got to wrangle it all in. And sometimes miscommunications occur, delays occur that are beyond anyone's control. So just understanding that you're working with somebody that will be transparent about that and also take accountability and keep you well informed throughout that process. Lastly, when timelines are provided, you're going to want to ensure that the advisor you're working with sticks to those timelines. If they set an expectation to get back to you by a certain time, that's an important thing. I can say as a professional in this industry, there's nothing that's more important to me than making sure that if I've set an expectation with a client about a communication touch point, sending an email, getting back to them on their questions, that to me is almost life or death. I need to make sure that I deliver on that timeline. So that's something that you would tremendously benefit from in the process. Lastly, and kind of just as an asterisk to this section, check out testimonials. Testimonials should be available on a mortgage professional's LinkedIn, Facebook, Instagram, on Zillow, on Google. You can perform your research to make sure you're working with the right person. Major point number 5, make sure their approach matches your goals. This is a little bit of where like the sales element comes in, and you're going to want to make sure you're working with the right advisor in this process because they should be number one concerned. Their number one top priority should be understanding you, your budget, what your goals, hopes, and dreams are in the world of real estate, that is, but also feel free to share anything else. And then align themselves in what they are doing for you in the process to those goals. Is it buying, refinancing? Is an ARM product something that you're open to? Do you have the risk appetite for that? Things like that are very important. Lastly, understand the difference between a broker and a lender. I'm not going to say anything on that. We're going to do that as our Did You Know segment next week. So I'm sorry for the cliffhanger, but we're going to go and discuss what the difference is between a broker and a lender next week on the episode. The final thought here is that a mortgage advisor isn't just someone who gets you a loan. It's someone who gets you. A mortgage advisor is not someone who gets you a loan. It's someone who gets you and supports you in your goals. They should be your advocate in the process. They should be your quarterback to help with communication because there's a lot of parties involved. And they should do so in a caring, compassionate, understanding manner. So those are my tips and tricks for finding the right lender. Our fun fact to tag out the episode today, because we're coming to the close of March, this is the last March episode. March was once the first month in the Roman calendar. So it marked the start of the military campaign season because the Roman Empire was an empire and they went to war a lot. And it was fittingly named after Mars, who was the god of war. So as we're exiting March, there's your little fun fact for the last full weekend ahead in March. I hope you found everything today helpful, useful, and informational. I am looking forward to next week's episode to provide you with some more updates. Again, I'm going to touch on broker versus lender. And then we're also going to take a look at some other data and key things that are coming out this week, particularly later on Friday, today if you're listening. We are getting the personal consumption expenditure inflation time. We're going to have to see how that looks. In the meantime, if there's anything that I can do to help you, your family, your clients, feel free to reach out anytime. My email address is peter.d'angelo@rate.com. You can also follow me on socials at peter.d'angelo.rate on Instagram. And I look forward to catching up with you next week with some more helpful information to help you in this real estate market. In the meantime, have an awesome weekend and take good care.